In September 1929, the stock market was hitting all-time highs week after week. The Dow Jones Industrial Average had more than tripled in less than 5 years. Everyone who owned stocks was rich, or at least thought they were rich. Technology was revolutionizing daily life in ways that seemed almost magical. Cars, radio, electricity, refrigerators, these weren't just conveniences, they were transforming what it meant to be American. The economy was booming. Unemployment was low. Corporate profits were soaring. And the smartest economists in the country were declaring that America had entered a new era where prosperity was permanent and economic cycles were obsolete. Yale University economist Irving Fisher, one of the most respected economic minds of his generation, gave an interview on October 17, 1929. He declared that stock prices had reached what looked like a permanently high plateau. Fisher wasn't some fringe voice. He was brilliant, influential, and wealthy from his own stock market investments. When he said stocks would keep rising, people listened. 8 days later, on October 24, Black Thursday arrived. The market crashed. By the time the destruction was complete in 1932, stocks had lost 89% of their value. Irving Fisher, who had been a millionaire many times over, was bankrupted. He spent the rest of his life in debt. And the permanently high plateau? It took 25 years for the market to recover to 1929 levels. But here's what matters right now in December 2024. The setup forming today is nearly identical to 1929, except the numbers are larger, the leverage is more extreme, and the technology amplifying the bubble is more powerful. Markets are hitting all-time highs despite clear signs of economic stress beneath the surface. Artificial intelligence is being hailed as the new era technology that changes everything, the same way cars and electricity were in the 1920s. Retail investors are using options leverage that makes 1920s margin buying look conservative. And the experts, the modern equivalents of Irving Fisher, are declaring that traditional valuation metrics don't matter anymore because this time is genuinely different. Based on every pattern from 1929 and every current market structure indicator, we're approaching a crash in 2025 that will make 2008 look like a correction. The timeline is visible. The warning signs are flashing. The parallels are impossible to ignore. And just like in 1929, the vast majority of investors are completely unprepared because they've been conditioned to believe that buying every dip works forever. This isn't ancient history for perspective. This is the immediate roadmap for the greatest wealth transfer opportunity of your lifetime, if you understand what happened in 1929, why it's happening again, and how to position before the crowd realizes the plateau was never permanent. The 1920s in America were a genuine economic boom, not just speculation, although speculation would eventually dominate. After World War I ended in 1918, America emerged as the world's leading economic power. European nations were devastated, their economies shattered by years of industrial warfare. America's factories, cities, and agricultural base were untouched. This created a massive competitive advantage that fueled rapid growth throughout the decade. Manufacturing exploded. The automobile industry transformed from luxury novelty to mass market necessity. Henry Ford's assembly line innovations dropped car prices dramatically. By 1929, there was roughly 1 car for every 5 Americans, an unthinkable ratio just decades earlier. Electrification was bringing modern conveniences to millions of homes. Refrigerators, washing machines, vacuum cleaners, all powered by electricity, were changing domestic life. Radio was creating the first true mass media, connecting the entire country to news, entertainment, and advertising simultaneously. These weren't financial innovations or accounting tricks. These were real technological advances creating genuine productivity gains and rising living standards for millions of people. Corporate profits were growing because companies were actually producing more with less labor. Wages were rising for many workers. Consumer spending was increasing. The economic boom was real. But something changed in the mid-1920s. The genuine prosperity created a psychological shift that would prove catastrophic. People started believing that the boom would continue forever, that America had discovered some formula for permanent growth that made traditional economic concerns obsolete. This belief, this conviction that the old rules didn't apply anymore, opened the door to speculation on a scale the country had never seen. The stock market became the focal point of national obsession. By 1929, somewhere between 1 and 2 million Americans owned stocks, a small percentage of the population but a massive increase from just a decade earlier. More importantly, the way people were buying stocks had become extremely dangerous. Margin buying was the weapon that would eventually destroy millions of investors. The concept was simple and seductive. You could buy stocks by putting down only 10% of the purchase price and borrowing the remaining 90% from your broker. As long as the stock price rose, this worked beautifully. You'd sell the stock at a profit, repay the loan, and pocket massive returns on your small initial investment. If you bought $100 worth of stock with $10 of your own money and the stock rose to $120, you'd made $20 profit on a $10 investment, a 200% return. This leverage magnified gains during the boom, making ordinary people feel like geniuses. But leverage works both ways. If the stock fell from $100 to $90, you'd lose your entire $10 investment even though the stock only declined 10%. And if it fell further, you owed your broker money. The broker would issue a margin call, demanding you either put up more money immediately or they'd sell your stock at whatever price they could get. This created a trap that millions of investors had walked into without understanding. They'd borrowed enormous sums relative to their actual wealth, betting that prices would only rise. The system worked perfectly as long as everyone kept buying. But it was a house of cards waiting for the first strong wind. By 1929, the psychology had reached a fever pitch. Ordinary people, shopkeepers, barbers, teachers, office workers, were trading stock tips like they were inside information. Everyone had a story about someone who'd gotten rich in the market. Newspapers published stories about secretaries and janitors who'd made fortunes through savvy stock picking. The examples were real, but they created a survivor bias that made the risks invisible. For every story about someone who got rich, there were hundreds of people making smaller gains or treading water, but those stories weren't exciting. The narrative became that anyone could beat the market with just a little knowledge and courage. This is when the really smart people should have gotten nervous. When taxi drivers are giving you stock tips, when shoeshine boys are talking about their portfolios, when speculation has become democratized to the point where everyone believes they're an investor, that's historically been the signal that a bubble has reached its final stage. But in 1929, the smart people weren't nervous. They were fully invested and telling everyone else to stay invested. Irving Fisher's permanently high plateau quote wasn't an outlier. It reflected the consensus among economic elites that something fundamental had changed, that America had figured out how to sustain growth indefinitely through technology and enlightened monetary policy. The Federal Reserve played a crucial role in inflating the bubble, though their actions seemed reasonable at the time. Throughout the mid-1920s, the Fed kept interest rates relatively low, around 3 to 4%. This made borrowing cheap, which encouraged the margin buying that fueled stock speculation. The Fed's reasoning was that the economy was strong, inflation was low, and there was no obvious need to tighten monetary policy. But cheap money always finds its way to speculation eventually. Instead of funding productive business investment, much of the borrowed money flowed into the stock market, inflating prices far beyond what corporate earnings could justify. By the summer of 1929, stock valuations had become completely detached from reality. The price-to-earnings ratio of the overall market had climbed above 25, well above historical norms. Some individual stocks were trading at 50 or 100 times earnings, valuations that could only make sense if profits grew exponentially for years. Dividend yields had fallen below 3%, meaning investors were accepting lower income from stocks than they could get from bonds, betting entirely on price appreciation. Every traditional measure of valuation was flashing red, warning that prices had risen too far too fast. But valuations don't matter in the final stage of a bubble. The only thing that matters is momentum and belief. The crash, when it finally came, happened with shocking speed. Tuesday, October 29, 1929, Black Tuesday, saw the Dow Jones fall nearly 12% in a single day on volume that overwhelmed the exchanges. But that wasn't the real damage. The real destruction happened over the following months and years as the crash triggered a depression that would last a decade. By July 1932, the Dow had fallen from its September 1929 peak of 381 to just 41. 89% of the value gone. Companies that had seemed invincible in 1929 were bankrupt by 1932. Millions of investors who'd bought on margin not only lost everything they'd invested but owed massive debts to their brokers. The human cost was staggering and often forgotten in discussions of market mechanics. People who'd felt wealthy in September 1929 were destitute by 1930. Life savings accumulated over decades vanished in months. Families lost their homes. Marriages dissolved under financial stress. Suicide rates spiked, though the famous stories about stockbrokers jumping from windows were largely myth. The reality was worse than the myth. Quiet desperation, unemployment, hunger, and the destruction of the middle class that had believed prosperity was permanent. The crash didn't just destroy wealth. It destroyed faith in the system, in capitalism itself, in the idea that hard work and saving could provide security. Now here's where the 1929 story becomes a blueprint for 2025. Every element that made 1929 catastrophic exists today in more extreme form. The genuine technological revolution that preceded the crash. We have that now with artificial intelligence, which is real and transformative but being used to justify insane valuations. The belief that we've entered a new era where old rules don't apply? That's the dominant narrative today. The cheap money from central banks that encouraged speculation? The Federal Reserve held rates near zero for over a decade and printed trillions, creating the everything bubble. The margin buying that magnified both gains and losses? Today's retail investors use options that provide 50-to-1 or 100-to-1 leverage, making 1920s margin look conservative. The experts declaring that valuations don't matter and this time is different. They're everywhere. The current Shiller-Cape ratio, which measures how expensive stocks are relative to earnings adjusted for inflation, stands at 34. That's the second highest level in recorded history. The only time it was higher was during the dot-com bubble in 2000, right before the Nasdaq crashed 78%. The only other time it was this elevated was 1929. Think about what that means. We're at valuation levels that have only occurred twice before, and both times preceded catastrophic crashes. Yet the narrative today is that these valuations are justified because technology is advancing faster than ever. The concentration of market gains in a handful of stocks mirrors 1929's momentum stocks. The Magnificent Seven, Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla, represent 32% of the S&P 500's total market capitalization. Just 7 companies are a third of the entire index. This concentration is dangerous because it means the market's apparent health depends on a tiny number of stocks continuing to rise. In 1929, similar concentration existed in the hot stocks of that era, RCA, General Electric, General Motors. When those stocks fell, they took everything down with them because they'd become such large portions of everyone's portfolio. Margin debt, the modern equivalent of 1920s margin buying, reached $663 billion in 2024. That's near the all-time record set in 2021 before the 2022 decline. But the real leverage is hidden in options markets. Retail investors now trade roughly 50 million option contracts per day. Options provide asymmetric leverage, allowing someone to control hundreds of shares of stock with a small premium payment. This creates exposure and risk that is largely invisible in traditional margin debt statistics. The leverage in the system is actually far higher than the headline numbers suggest, just like in 1929 when the full extent of margin buying wasn't captured in official statistics. Consumer confidence in December 2024 is at levels typically seen at market peaks. Survey after survey shows investors expecting stocks to rise, planning to increase their equity allocations, and expressing minimal concern about downside risk. This is classic late-cycle psychology. Fear has been completely bred out of the market by 15 years of the Fed bailing out every decline. The Pavlovian response is buy the dip because the Fed will save you. This works until it doesn't. In 1929, investors had the same learned behavior from the mid-1920s bull market. Then it stopped working, and the people who'd been conditioned to buy every dip were destroyed. Corporate debt has exploded to levels that make historical comparisons difficult. U.S. non-financial corporate debt exceeds $13 trillion, roughly 120% of GDP. Companies borrowed aggressively when rates were near zero, assuming they could always refinance or grow their way out. But now rates are over 5%, and revenues are under pressure. The debt service costs are consuming larger portions of cash flow. Companies that seemed financially healthy when borrowing was cheap are now struggling. This is the setup for a wave of defaults that will spread from zombie companies to mainstream corporations, triggering credit market stress that feeds back into equity markets. The modern Irving Fishers are everywhere, and they have larger platforms than Fisher ever dreamed of. Portfolio managers with billions under management appear on financial television explaining why valuations don't matter because AI will grow earnings faster than anyone expects. They point to the 1990s and argue that markets can stay expensive for years before any correction. They note that corporate buybacks provide permanent support under stock prices. They argue that inflation makes higher nominal stock prices inevitable. Every rationalization is technically correct in isolation, but none of them address the fundamental problem that prices have risen far beyond what current or foreseeable future earnings can support. The specific timing of a crash is always impossible to predict with precision, but the window is narrowing. Based on every historical parallel and every current warning signal, the most likely timeline runs from the second quarter of 2025 through the end of that year. Right now through the first quarter of 2025, we're likely still in the final euphoric phase. Markets grinding higher, momentum continuing, retail FOMO intensifying, experts becoming more confident, warnings being dismissed. This is the equivalent of summer 1929, when everything looked perfect and anyone expressing concern was dismissed as a permabear who didn't understand the new era. The second quarter of 2025 is when the cracks will likely start appearing more obviously. Corporate earnings will begin missing estimates as the lag from higher rates and slowing consumer spending finally hits. Some of the Magnificent Seven will report results that disappoint relative to their astronomical valuations. Credit spreads will start widening as investors recognize that default risk is rising. Unemployment, which has been remarkably stable, will tick higher as companies finally start cutting costs more aggressively. These won't be catastrophic developments individually, but they'll create enough nervousness to pause the relentless buying. The third and fourth quarters of 2025 are when the real danger arrives. Once the momentum breaks and investors start questioning valuations, once the bid starts to disappear and volatility rises, the leverage in the system becomes the accelerant. Options expire worthless. Margin calls trigger force selling. Retail investors who were up enormous amounts on paper watch those gains evaporate and panic. Institutional investors face redemptions from clients and have to liquidate positions. The selling feeds on itself exactly as it did in 1929, except it happens faster now because everything is electronic and algorithmic. What took weeks in 1929 could take days or even hours in 2025. What do you do? Here's exactly how you position before the permanently high plateau reveals itself as the illusion it always was. Step 1 is building a 50 to 60% cash position by the end of the first quarter of 2025. This seems insane to suggest when markets are at all-time highs and momentum is strong. Every behavioral impulse will tell you that you're being too cautious, that you're missing out on gains, that you should stay fully invested. But you're not optimizing for the next 3 months. You're positioning for the next 3 years. Use Treasury money market funds earning over 5%. The opportunity cost of holding cash is minimal compared to the catastrophic risk of being fully invested when the crash comes. Step 2 is understanding that diversification provides no protection during a true crash. In 1929, stocks, bonds, real estate, commodities, everything correlated to one and fell together. The only assets that held value were cash and short-term government securities. In 2025, the same thing will happen. Your 60-40 portfolio, your international diversification, your alternatives allocation, none of it will matter. When margin calls trigger force selling and panic becomes universal, everything gets sold because people need liquidity. The only diversification that works is being in cash before the crash and deployed into quality assets during the panic. Step 3 is identifying the companies that will survive and eventually thrive after the crash. This is not about finding the stocks that will go down least during the decline. Everything will go down significantly. This is about finding businesses so fundamentally strong that they'll make it through the depression that follows and emerge in positions to dominate their industries. You want companies with minimal debt, strong free cash flow, essential products or services that maintain demand regardless of economic conditions, and balance sheets that can survive years of reduced revenue. Healthcare companies that provide critical treatments. Utility companies that supply electricity. Consumer staple companies that sell food and household necessities. Energy companies that benefit from long-term supply-demand dynamics. Step 4 is having a deployment plan that doesn't require you to catch the bottom. Nobody will catch the bottom. The bottom will only be obvious in hindsight. Instead, you deploy in stages as fear escalates. When markets are down 30% from their peaks, deploy 15% of your cash into your quality company watch list. Down 45%, deploy another 20%. Down 60%, deploy another 20%. This approach ensures you're buying progressively cheaper while maintaining reserves if the decline exceeds even worst-case scenarios. After 1929, the investors who bought in stages during the 1930 to 1932 decline and held through the recovery made generational wealth over the following decades. Step 5 is preparing psychologically for how violent and scary the actual crash will be. Reading about 1929 doesn't prepare you for living through a similar event. When you watch your portfolio lose 30% in weeks, when financial media is proclaiming the end of capitalism, when experts who were bullish are now predicting depression, when your friends and family are panicking and begging you to sell, your instincts will scream at you to preserve whatever you have left. This is when fortunes are made or lost. The people who sell into the panic lock in catastrophic losses. The people who buy during the panic, when doing so feels like the stupidest decision possible, set themselves up for decades of compounding returns. Here are the specific warning signals that will tell you the 1929 playbook is accelerating. Signal 1 is options market behavior. In 2024, retail investors are using options for speculation and income generation at record levels. When you start seeing daily options volume decline significantly, it means retail investors are pulling back, either because they're losing money or because they're getting nervous. This typically precedes broader market declines by 30 to 60 days. Monitor options volume through free data from the CBOE. A 20% decline from recent peaks is your warning. Signal 2 is the VIX Volatility Index. Throughout 2024, VIX has mostly traded between 12 and 16, indicating complacency. When VIX spikes above 30 and stays elevated for more than a week, it means options markets are pricing in serious stress. This doesn't mean sell everything immediately. It means move to maximum cash allocation and prepare for deployment. VIX above 30 has preceded every major market crash in the modern era. It's free to monitor daily. Signal 3 is the divergence between the Magnificent Seven and the broader market. As of late 2024, the concentration in top stocks is extreme. When you start seeing these 7 stocks underperform the S&P 500, when their earnings disappoint or valuations finally matter, it means the narrow leadership that has held the market up is breaking. This is equivalent to the momentum stocks of 1929 finally rolling over. Track this through simple relative performance charts available on any financial website. Signal 4 is credit spreads widening. The spread between corporate bond yields and treasury yields tells you how much extra return investors demand to accept corporate default risk. As of late 2024, spreads are relatively tight, indicating confidence. When high-yield spreads widen above 600 basis points, investment grade above 200, it means credit markets are pricing in significant default risk. This precedes equity market crashes because credit investors tend to see problems before equity investors. Use Fred economic data or Bloomberg to track this weekly. Signal 5 is unemployment starting to rise. As of December 2024, unemployment is around 3.7%, historically low. When it crosses 4.5%, it means the labor market is weakening. When it crosses 5%, recession is virtually certain and markets are overvalued relative to the earnings recession that will follow. Employment data is released monthly. Watch it religiously because unemployment is the single most important economic indicator for predicting consumer spending and corporate earnings. Your action plan for the next 6 months must be specific and measurable. In January 2025, audit your entire portfolio and calculate your true equity exposure including retirement accounts and any holdings you don't actively manage. Most people are shocked when they realize how equity heavy they are. Begin moving to 35% cash allocation. This means selling positions. It will feel wrong because markets are likely still rising. Do it anyway. In February 2025, reach 45% cash. Build your watch list of 25 to 30 quality companies. For each company, note the price you'd be willing to pay, which should be 40 to 60% below current levels. Research their balance sheets, debt levels, and business models. You need to know these companies intimately so you can act with confidence when they're on sale during the panic. In March 2025, reach 55 to 60% cash allocation. Set up monitoring for the 5 warning signals. Create a simple spreadsheet that you update weekly with VIX level, credit spreads, unemployment rate, Magnificent 7 performance, and options volume. Color code the cells so you can see at a glance when multiple signals are flashing red. Begin doing mental rehearsals where you visualize markets falling 40% and you deploying capital while everyone around you panics. From April through June 2025, maintain discipline. Markets may keep rising during this period, which will make your cash position feel like a mistake. Ignore it. You're not trying to maximize returns over 3 months. You're positioning for a once-in-a-generation opportunity. Monitor your signals weekly. Stay informed but don't get caught up in the narratives about new eras and paradigm shifts. You've seen this movie before in 1929. You know how it ends. From July through December 2025, this is when the crash likely arrives. When it does, when markets are falling and fear is overwhelming, that's when you execute your deployment plan. Ignore your emotions. Ignore the experts predicting depression. Ignore your friends and family telling you to wait for certainty. Buy in stages according to your plan. The people who bought during 1930, 1931, and 1932 while everyone else was frozen in fear made fortunes over the following 20 years. The parallels between 1929 and today aren't subtle. They're overwhelming. In 1929, technological revolution created real prosperity that morphed into speculative mania. In 2024, artificial intelligence is real but being used to justify bubble valuations. In 1929, cheap money from the Fed fueled speculation. In 2024, over a decade of zero rates and quantitative easing created the everything bubble. In 1929, margin buying magnified gains and losses. In 2024, options provide even more leverage to retail investors who don't understand the risk. In 1929, experts declared a permanently high plateau. In 2024, experts declare that AI changes everything and traditional metrics don't matter. In 1929, the concentration in momentum stocks made the market fragile. In 2024, 7 stocks are a third of the S&P 500. In 1929, everyone was convinced this time was different. In 2024, the conviction is even stronger because we have better technology and supposedly smarter central banks. But technology doesn't repeal human nature. And central banks can't prevent the mathematics of excessive debt and valuation from eventually asserting themselves. Irving Fisher was brilliant. He understood economic theory better than almost anyone alive. He built mathematical models. He studied data. He was confident that stocks had reached a permanently high plateau because he genuinely believed that modern monetary policy and technological advancement had changed the fundamental nature of capitalism. He was catastrophically wrong. Not because he was stupid but because brilliance is no defense against bubble psychology and the inevitable mean reversion that follows extreme overvaluation. Today's experts are making the same mistake. They point to AI and argue that earnings growth will accelerate. They note that central banks have tools to prevent deep recessions. They observe that buybacks provide price support. All of these things are true. None of them changes the fact that stocks trading at 34 times inflation-adjusted earnings have historically produced terrible returns over the following decade and often crashed spectacularly first. The permanently high plateau was a lie in 1929. It's a lie today. And the people who believe it will pay the same price Fisher and millions of others paid. History doesn't repeat, but the patterns are impossible to ignore. Technological revolution leading to speculative excess. Cheap money amplifying the bubble. Experts rationalizing insane valuations. Retail investors convinced that this time is different. Leverage throughout the system turning manageable risk into catastrophic vulnerability. And finally, the crash that destroys wealth and faith simultaneously. We've seen this movie before. We know how it ends. The question is whether you'll be prepared. In September 1929, the market hit all-time highs. By July 1932, it had fallen 89%. The recovery took 25 years. The Great Depression lasted a decade. Millions of people who believed in a permanently high plateau lost everything. The investors who understood that peaks are followed by crashes, who positioned defensively before the fall, who bought quality assets during the panic while everyone else was frozen in fear, those investors not only survived but thrived. They became the wealthy class of the next generation. The same opportunity is approaching. The same pattern is repeating. The same warning signs are flashing. And just like in 1929, almost nobody sees it coming because they've been conditioned to believe that crashes happen to other people in other eras. They don't happen in modern markets with sophisticated central banks and advanced technology. Except they do. They always have. They always will. Because human psychology doesn't change and mathematics doesn't care about narratives. If this gave you the exact playbook to position before the 2025 crash that will mirror 1929, hit subscribe. The permanently high plateau was always an illusion. The question is whether you'll see through it before the fall or learn the lesson the expensive way.